Now here we're going to turn to Europe and we want to look at some of the things that have happened so far. Eurozone aggregate, when you look at May, industrial production expected at 0.3, came in at 0.2. Year over year expected at negative 1.2, came at negative 2.2. Trade balance, continues to get a bit worse. CPI, when you look at what it was, it came in at 5.5%. The core, though, is where we get some of the problems, where it was expected at 5.4, came in at 5.5. And the reason why we want to talk about that is because that's where we see those issues continuing to permeate through the system, especially when you look at the Eurozone aggregate side. Consumer confidence continues to be negative, but again, slightly better. And then you turn to Germany, which when you look at wholesale price index, it's still negative, but not as negative as it was when you start to look at some of the pivots. And it's likely to go higher again in July because, again, energy costs went up. And energy costs going up is going to help push that price index, quote unquote, more positive. Then you look at PPI, which was expected at negative 0.4 month on month, came in at negative 0.3. But then year on year was expected flat, came in at 0.1. So you're starting to get a little bit of that pivot back up, which is why we're seeing some of those issues, remain pervasive through the system, which is going to, again, put the ECB on their back foot and force them to continue to raise rates. Now, I had a good question from one of our clients when they asked, what do you think about the UK, because realistically the BOE was one of the first to raise rates when you're looking at the UK, US, and ECB. So realistically, that's going to be a problem. And then when you look at what we have in the US, the US is another one or two, but the ECB was the last, and that's going to be a bigger issue. Now, something that is going to hit the UK, and for those that don't know this, the U.S. is one of the few places that have 30-year fixed mortgages. Most places have 10-year ARMs or adjusted rate mortgages. And it strikes varying, every 3 months, every 6 months. So when you look at what's going to happen in the UK, they have actually a big slug of ARMs. See their monthly rates go up $2,000 to $3,000. Like, that is a sizable number when you look at some of those impacts, which I think have to be considered, especially when you're looking at Europe in general, because they're similar in the sense of they have ARMs or adjusted rate mortgages, not fixed. CPI in France came in, again, slightly, mostly in line, still elevated. Business confidence came in line. Production outlook indicator came in like last month at -9, and then production outlook came in at -5, which is again, a bigger decline in general. Italy, trade balance was fairly there. Government debt continues to be a problem. CPI still at 6.7%. So current account balance, had a little bit of a reversal, but realistically, you're still seeing some of those pressure points, especially when you look at, Germany. So Germany contribution to industrial production still steeply negative. When you look at the levels of it, the main driver of Germany's industrial malaise has shifted from investment goods as supply chains normalize, reflecting import substitution due to recent shocks eroding competitiveness. A turn in the industry cycle also plays a role. So again, we're still seeing those pressures while rents keep rising in major German cities as home prices stall. So if you can't buy a home, again, back to the rates, back to ARMs, well, you're going to have to rent, and rents keep going up, which is going to diminish the amount people can spend. So then they're going to need a higher wage. But the Eurozone wage pressure, the view is it will peak at the end of this year. So wage pressure in Eurozone is likely to peak at the end of the year, following peaks in CPI with a 12-month lag. The wage growth slowing to 3.5% end of 2024 and 2.5% in 2025. Even with the margin of error, it does not look like a massive wage price spiral. But when you look at living costs going back up, is that going to slow down some of these adjustments, which is why we still think the ECB is going to stay aggressive, especially when you look at Euro area's core CPI. Initial estimate 5.4 came in at 5.5. Euro area service CPI reaccelerated to 5.4%, which again is going to be tough for the ECB to look at this and say, well, we have to slow down, wages are expected to diminish. Well, no, you're actually getting a reacceleration to the upside, which is going to put them on their back foot again. German 2023 GDP forecast, latest came in at negative 0.3. 2024 came in at 1%. But it's interesting because when you look at the expectation for 2024, it's bouncing around. We think what we've talked about is that you're going to get that continuous negative component lasting not only in 2023, but well into 2024, pulling that lower. Then when we look at the Bloomberg City Tracker, now turning to France, well, French housing prices dropped to the lowest level in 4 years. Asking prices in June decreased by 4.1%, falling to €10,936 per square meter, the lowest level since January 2019, as you get people who just can't afford it and things slowing down. German wholesale price index still negative, but again, the problems remain pervasive when you look at some of the core levels of of inflation. Fewer homes are being completed in Germany while the construction backlog grows. Also, again, this is something that's playing out everywhere where the construction backflow is there, but it's not being built. Rates are expensive. It's not so much that you can't get wood or other raw materials anymore. It's that rates are a struggle because you're unable to sell in this market, which is why you're seeing fewer homes, keeping those rents moving higher and keeping people limited in what they can purchase. New building permits in Germany have slumped since the start of 2021 because, well, why are you going to issue new permits if you can't complete what's already there, leaving things in a lurch when you're looking at some of that timing. And then stick your service inflation to slow the decline in core inflation. For anybody that has been following us, we have been, that's something that we've been saying the whole time. In terms of stick your service inflation, it is the main crux of why that core inflation isn't going through. And then the pass-through of policy rate to retail deposits slower than in previous cycles, which is also becoming an impact because the interest rate spread is still steeply negative. So as a consumer, people, like that chart showed, well, wage spirals are going to slow. It's like, well, I'm not making anything in my bank. I'm still, wages are coming down. Again, in general, you're going to see less spending, which is why we're so cautious on services. We think that's going to be the biggest drop, especially when you look at Europe, but not just Europe, everywhere, as you get that pressure. But rents going up, food prices going up, cost of living, core inflation going up based on service inflation and other things that you're buying on a regular basis. And you're not getting any of that benefit from the bank, which is why, again, we see rates going up, more pressure ahead as the consumer slows. So that's what we have for you on the European side. We did a lot last week, so we don't have as much to talk about today. And then in the next segment, we're going to go deeper into China, the most recent data, and some of the other key pieces that we have going forward.